this morning's webinar, Implementing ASU 2016-14, Leveraging the New Standard to Your Advantage. My name is Jennifer Disharoon, and I am the Marketing Director at Gelman, Rosenberg Freedman. I'll be moderating the program today, and I'd like to start with some quick, some quick housekeeping items. So if you have any technical questions or issues during the webinar, please use the chat function to speak with our webinar administrator. Technical assistance is also available from WebEx at the number shown here. Please note that this webinar will be recorded and it will be made available on our website following the event. Webinar participants today seeking CPE credit must complete and submit a short evaluation survey that will appear automatically immediately following this webinar. Throughout the webinar, there will be 3 polling questions. There will be a space to the right of your screen for you to record and submit your answers. You will also be asked to recall the 3 words shared during the presentation in order to receive CPE credit. If you have an active pop-up blocker, please take a moment now and disable it so you do not block the survey at the end. Any technical questions about the survey may be addressed to Alina Stone. In addition to the webinar recording, the presentation slides will also be made available for download on our website. As the title of today's webinar implies, today's learning objective is to understand the requirements and implementation of the newly released FASB Accounting Standards Update 2016-14. 1 CPE credit is available to attendees of today's webinar. At this time, I would like to introduce our instructors. Trevor Williams is a nonprofit audit partner with over 20 years of experience in the public accounting arena, and his audit experience has included auditing tax-exempt organizations, including associations, foundations, and other charitable institutions. Walt Darendowski is also a nonprofit audit partner with the firm. He has 16 years of experience in nonprofit audit and accounting, and his work takes him around the world to complete annual audit engagements for a number of international NGO clients. So with that, I'm going to turn the presentation over to Trevor Williams, who will get us started.
Thank you, Jennifer. So why was ASU 2016-14 implemented? The National Advisory Committee and other stakeholders lobbied for better information, and that information will significantly affect how nonprofit organizations communicate with its stakeholders. Another objective is that those stakeholders wanted improved financial statement presentations of its not-for-profit organizations, specifically regarding net asset classifications, going from the current 3 net asset classifications to 2, information regarding liquidity, financial performance, and cash flows in the financial statements and also in the notes to the financial statements. And lastly, it was hoped to reduce the complexities, deficiencies, and inconsistencies in the non-for-profit financial statements and notes. I think overall, the stakeholders, as well as the National Advisory Committee, wanted to enable all the nonprofit organizations to tell their financial story, and it's believed that these particular changes will do just that. So ASU 2016-14 was finalized on August 18, 2016. I think it should be noted at this time that this particular update is the first update affecting non-for-profit financial statement presentation in over 30 years. I think all of us on this webinar today can remember that thing called FASB 116 and 117. It's hard to believe that those particular FASBs were first issued in 1993 and effective for fiscal years beginning after December 15th, 1994. So again, it's been quite a long time coming. ASU 2016-14 is specifically for the presentation of financial statements of non-for-profit entities. It applies to nonprofit organizations, including non-governmental entities such as charities, foundations, college and universities, healthcare providers, cultural institutions, religious organizations, trade associations, and other nonprofits. And now to the first polling question.
Thank you, Trevor. Sorry about the delay. So I'm going to go ahead and read the question. These regulations will begin to go into effect for nonprofits with the calendar year ending December 31st, 2018. Has your organization implemented them yet? We have three choices here: yes, no, but we are planning to implement them prior to the December 31st, 2018 deadline. No, and we don't yet have plans to implement them. So go ahead and record your answers, and while we're waiting for the group to record their answer, I'll give you the first CPE word. The first CPE word today is asset. Again, the first CPE word is asset. Okay, and it looks like our poll has come to an end. Hopefully you can see the results. It looks like most have not yet, but they're planning to implement prior to December 31st. Great. With that, Trevor, I will turn it back to you.
Thank you, Jennifer. ASU 2016-14 is in two phases. Phase 1, which we will talk about today, and Phase 2, which it should be noted that FASB has relegated some of those changes that were contemplated in the original exposure draft to a second phase of this project, and this will be addressed sometime in the future. But again, for today's webinar, we are dealing with strictly Phase 1. And you see from this particular slide the key areas of the provisions. The first key area is under net asset classifications. Again, the classes of net assets will go from 3 net asset classes to 2. Additionally, there will be disclosure of board-designated assets. And again, these net assets are without donor restrictions, but subject to self-imposed restrictions by the organization's governance board. These are considered net assets without restrictions. Additionally, there will be some information that is necessary to disclose underwater endowments that I'll touch on later, and place in service option for expirations of capital restrictions. Here it should be noted that what this means is that those contributions that are restricted for the acquisition of long-lived assets are currently recorded as increases in temporarily restricted net assets, and the releases to unrestricted can either be when placed in service or over the useful life of those restricted assets. With ASU 2016-14, remove that option. You can still record the contribution as net assets with restrictions, but it will release in its entirety to net assets without restrictions when the asset is acquired and placed in service, unless the donor places a time restriction on the use of the asset. Another key area are in the expenses, by nature or natural classification, and by function. And by function, we mean the breakout between programmatic expenses and supporting services. By natural classification, it's really referring to the functional expense statement. And currently, only voluntary health and welfare organizations are required to have a functional expense statement. With ASU 2016-14, all applicable non-for-profit organizations are required to have that statement. It can be presented on the statement of activities or as a separate statement, again as a statement of functional expenses, but definitely not as a supplemental schedule or in a footnote disclosure. Next, under expenses, this particular update allows the netting of external, direct, internal investment expenses against investment returns and disclosures. Those expenses should not be included in the above bullet point regarding the expenses. Additionally, gains and losses from the sale of fixed assets or from insurance proceeds should not be included in the expenses. Next, this standard is looking for enhanced disclosures about cost allocations. Again, with the requirement of the functional expense statement, there needs to be a footnote disclosure regarding how those general and administrative costs are being allocated to the programs. Another key area is regarding liquidity, both qualitatively and quantitatively. And to fill the qualitative requirements, organizations should assess how they manage their liquid resources to ensure they can meet their cash needs for general expenses as of and within 1 year, respectively, of the statement of financial position date. Organizations should also evaluate their financial assets to determine their availability to meet cash needs and examine external limits imposed by donors, laws, and contracts, and to account for, analyze, and track any internal limits imposed by governing board decisions. Under qualitative, the non-for-profit organization should take a look at special borrowing arrangements or instances whereby the entity has not maintained appropriate amounts of cash as required by the donor-imposed restriction, and limitations that result from contractual agreements with suppliers, creditors, loan covenants, and other sources. Another key area has to do with operating measures and the statement of cash flows, the direct versus indirect. As my colleague Walt Darengowski will touch on in more detail later in this webinar, ASU 2016-14 allows the organization to have free choice between the direct or indirect method to present the operating section of the cash flow statement. Additionally, the indirect reconciliation is no longer required if choosing to select the direct method. It's believed by FASB that removing this requirement may increase non-for-profit organizations choosing to use the direct method. When is the ASU effective? For annual financial statements, fiscal years beginning after December 15, 2017, interim periods with fiscal years beginning after December 15, 2018, which is applicable to interim financial statements, is permitted but not required in the initial year of application. This update should be applied on a retrospective basis. Apply all provision in the year of adoption. Disclose the nature of reclassifications or restatement and their effects, if any. And for comparative year financial statements, apply all provisions, but may elect not to include the disclosures regarding liquidity and expenses by nature and function. Again, the functional expense statement. The organizations have the option to early adopt, but must apply the regular transition provisions. So again, one of the main key areas of this update has to do with the net asset classes. Currently, there are 3 net asset classes: unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. The unrestricted net asset classification will be replaced with net assets without donor restrictions. Temporarily restricted and permanently restricted net assets will be replaced with net assets with donor restrictions. Again, you'll see an update for the 2 classes of net assets. Again, without donor restrictions, you have undesignated and board designated. And again, with board designated net assets, those are net assets without donor restrictions, but are subject to self-imposed limits by actions of the governing board. Board designated net assets may be earmarked for future programs, investment, contingencies, purchase, or construction of fixed assets or other uses. Again, these net assets are considered without restrictions. And for board-designated net assets, you must disclose the amount, purpose, and type of board designation. Net assets with donor restrictions, you are required to disclose the nature, amount of donor and timing restrictions at end of the period and how the restrictions affect the use of the resources. It includes endowments invested in perpetuity and underwater endowments. Again, donor-restricted endowment funds are those funds created by the donor, stipulating that the required investment of the gift is to remain in perpetuity or for a specified time. Underwater endowments are those donor-restricted endowment funds for which the fair value of the fund at the reporting date is less than either the original gift amount or the amount required to be maintained by the donor or by law. For underwater endowments, there's some required disclosures as a result of this update, and you'll see there in the various bullet points. But I think it's important to repeat here that, again, a donor-restricted endowment fund that is underwater, you're required to show all accumulated losses of that fund should be included within net assets with restrictions. And the nonprofit organization is required to disclose the aggregate fair value of the endowed funds, the organization's policy and any actions taken during the period, the aggregate original gift amount or level required by donor or law to be maintained, and the aggregate amount by which the funds are underwater included in net asset with donor restriction. Here you'll see we have an example of the statement of financial position. This particular slide in the webinar has been converted from the current format to the format under ASU 2016-14. Here you'll see there's a change in the cash and cash equivalents line, and I believe this was a combination of combining the unrestricted and the restricted cash into one. And that will match the cash flow statement. That is also a required statement in the audited financial statements. I would like to note here to you all, when doing this and netting the restricted cash and the unrestricted cash in one line item, you're required to have a reconciliation somewhere in the footnote disclosures. And looking at the bottom of this statement, you'll see the formally unrestricted, temporarily restricted, and permanently restricted net asset classifications replaced with net assets without donor restrictions and net asset with donor restrictions. This slide here is the statement of activities and change in net assets. Again, it's been converted with the new update. And I just would like to point out to you all on the webinar today that there are several options that you are allowed to use for presenting this particular statement. The particular presentation that you have in front of you is a 3-column presentation. It shows net assets without donor restrictions, net assets with donor restrictions, and total. You are also given the opportunity, if you should show a desire, to present in a single column format, starting with net assets without donor restrictions and followed by net assets with donor restrictions. It's believed that some organization would like that particular presentation when showing comparative financial statements. And the third option available to nonprofit organizations with this update is to present 2 statements of activity. The first statement showing the net assets without restriction, and the second statement showing the net asset with donor restriction. But in this particular presentation, I just want to point out a couple things. The first is you'll see the net assets released in more detail. I think some of us remember the current presentation where it will just be one line, net assets released from restriction. Additionally, you'll also see that the expenses are broken out between programmatic, management, and general. And then after that, you'll see the non-operating activities, the fire loss, as well as the actuarial loss. And the last thing on this particular statement I'll point out is rather than showing a functional expense statement by natural category, they have chosen to show this in a footnote. Hence, you see note F there. This slide is a footnote disclosure with net assets with donor restriction. Here you'll see, again, it's much more detailed information here. It's broken out by programmatic activities. Additionally, you'll see the breakout due to passage of time, as well as you'll see the permanently restricted net assets shown at the bottom of this particular footnote disclosure. So again, in comparing to what we've seen previously, this particular footnote disclosure is a lot more detailed and the types of information that the stakeholders of these organizations would be looking for. Here you'll see an endowment net asset footnote disclosure. Again, taking a look at the table to your left, you see it's broken out between board designated and donor restricted endowment funds. And that first column is the column net assets without donor restrictions. Again, board designated endowed funds are net assets without donor restrictions. And again, the donor restricted endowment funds are in that second column with donor restrictions and the total. The box on your right shows the changes in the endowment net assets for the fiscal year. And again, it's a running total from the beginning of the year and the activity during the year to end with the net assets at the end of the year.
Thanks, Trevor. We've arrived at our second polling question. Which of the key Phase 1 changes is most important to your organization? We've given you several choices here. Allowing free choice between direct method and indirect method in presenting operating cash flows, improving presentation and disclosures for net asset classes, enhancing information about the liquidity and availability of financial resources, and improving reporting of investment return, providing better information about expenses and expense allocation, or all of the above. Please go ahead and record your answers, and while we're waiting, I will give you the second CPE word, which is audit. Again, the second CPE word is audit. Okay. All right, the poll has ended, and it looks like we had a lot of people who didn't answer this particular poll question. So, but it still looks like many of you are concerned about all of these changes. With that, I will turn the presentation over to Walt.
Thank you, Jennifer, and thank you everyone for attending today's webinar. I'm going to cover the remainder of the ASU, discuss a little bit about Phase 2, and conclude with a to-do list to help your organization leverage the new standard to your advantage. And at the end, we'll have some time to answer any questions from our audience. Now let's start the second key area, and that is the classification of expenses, including investment returns. The new ASU now requires to present expenses by function and nature in one location. So this presentation by natural classification and functional classification can be done on the face of the statement of activity, in a separate statement, or the notes in the financial statements. Now, many of your organizations may already be presenting a functional expense statement, so this part of the ASU may not have a big effect on you. However, if you haven't been presenting this in the past, it will be something different and will require some information gathering to have this information on hand. But even if you were preparing a functional expense statement, there is a piece of the new ASU standard that will affect you, and that is the requirement to disclose the method used to allocate the costs among the programs and supporting services. For an example, The non-for-profit organization may have to include in the footnote that expenses may be allocated by square footage, while salaries and benefits may be allocated on the basis of estimates of time and effort if you have a timesheet system in place. So this will be something in the area that will need to be added to the financial statement disclosures. And then included under the classification of expenses area, as we mentioned earlier, there are new requirements on the investment return. The FASB has noticed that there has been inconsistencies on the way this has been reported, and now under this ASU, it is required that the investment return be net of external and direct internal investment expenses. One thing to note that is this can be repeated in multiple lines if you present the investment income in various places. For an example, if you have an investment income from operations shown separately, that will be allowed, but under this, there is no disclosure of the net expenses required. And they changed the requirements of the component of investment income, and they no longer require that. So you want to be careful when you are doing your expense analysis to make sure that those direct internal investment expenses are not included there, since they will be netted with your investment return. The ASU has some further guidance as well on the allocations from the M&G expenses. So if you have some questions on that, they did present information that you can refer to. The next key area of the ASU is liquidity. This provision requires for all non-for-profits to disclose both qualitative and quantitative information on liquidity. On the qualitative piece, this is a note disclosure that will be required on the liquidity and the availability of resources within 1 year of the date of the statement of financial position. Additionally, there is a quantitative requirement, and this can be done either by note disclosure or on the face of the statement of financial position. Included in this quantitative requirement requires the non-for-profit to disclose the availability of the financial assets at the date of the statement of financial position to meet cash needs for general expenditures within 1 year of the financial statement date. So financial assets are tangible, liquid assets that do not have restrictions by either the donor or the board. If you are envisioning the statement of financial position, you have your total assets. You will subtract out your non-financial assets, which would be your property, plant and equipment, inventory, prepaid expenses, and that will bring you to your total financial assets. Now, the availability of a financial asset can be affected by several things. It could be the nature of the financial asset. It could be external limits imposed by donors or contracts, or even internal limits by the board. Here is an example reproduced directly from the ASU to give us some guidance to move forward. At the top of this example, here is a quantitative disclosure, and it's in table format. And as you can see, it starts with the financial assets at year end and basically then subtracts out those unavailable for general expenditures within that year. So you could see any donor or contractual restrictions and any board restrictions that basically brings you down to that final number, which are the financial assets available to meet the cash needs for general expenditures within 1 year. Now, you could present this in various ways and still meet the requirements of the standard. You could start with total assets, and you could show total assets backing out the property, plant and equipment, prepaids, inventory, and any other non-financial assets, and then come to your financial assets at year end, and then again continue down the table as shown here. Or you could even list out just all the different pieces that makes up financial assets, listing out cash, accounts receivable, investments, and basically coming down to the total of financial assets at year end, and then again down the rest of the reductions to get you to the ending number. So you have a lot of leeway on how you want to present it. It's really going to be up to you and how much you want to disclose in your financial statements. And the second part of this disclosure is the qualitative disclosure, and in this example is on the right side. And again, this is on liquidity and the availability of the resources within 1 year. There are several examples, and I encourage you to look at those to come up with any ideas that may affect you, but highlighting some important points, I think, of this disclosure, and that the very first sentence is substantially supported by restricted contributions, and that they must maintain sufficient resources to meet those responsibilities, and that the financial assets may not be available for general expenditures within 1 year because of that. And then it goes on to say how you are going to meet some of those needs and how you have invested cash and basically your surpluses, and the fact that you have a liquidity reserve that the board may have a fund that they could draw on in the event of any financial distress. So again, this is one that I think is going to take some thought and will be something very different that the non-for-profit will have to disclose under this new standard. The next key area is the statement of cash flow. In the original exposure draft, they were requiring all non-for-profits to use the direct method of cash flows, and this was very controversial. But in the end, the FASB changed their position and allowed the non-for-profit to make the choice if they wanted to use either the direct or indirect method. However, if you choose the direct method, then you do not have to present the indirect reconciliation that normally is shown on the bottom of the statement of cash flow when you use the direct method. And as we mentioned earlier, there was a lot of comments that came back from the proposal draft, and people gave many reasons as to whichever way they supported, and I think a lot of the smaller non-for-profits were against this, or even the preparers for the small non-for-profits, because this was going to be a lot of work, and the cost was going to outweigh the benefits. But FASB apparently listened to some of the arguments that people left, and it left it up to the organization to decide which method to use. The last provision is reporting expiration of capital restrictions. So if the non-for-profit has gifts or cash or other assets that are now to be used to acquire or construct a long-lived asset like a building, the non-for-profit is now required under this ASU to use the place and service approach in absence of donor-implied restrictions. This eliminates the option to release the donor-imposed restriction over the estimated useful life of the acquired asset. Prior to this, the non-for-profit had two options. One, you could use the place and service, or you could use over the useful life or implied time restriction. But now in the absence of a donor restriction, you can no longer use the implied time restriction. For an example, if the organization has a capital campaign to raise funds to either purchase or construct a building, these contributions will be recorded as revenue with donor restrictions and then carried into net assets with donor restrictions until the building is placed into service. Then the entire balance will be released, and the organization will no longer be able to release these over the remaining useful life. And one important thing to note here is these provisions are all applied on a retrospective basis. So if you have an asset that you have been releasing over time, then the organization will have to look at that and go back and do a prior period adjustment to release the asset to properly classify as net asset without donor restriction and have the correct number at the beginning of the year. Now, what we have included in our presentation today is to provide you a to-do list to leverage and start thinking about implementing this new ASU. We want you all to be ready and understand that the ASU and be ready for when we come in to perform the audit. By being educated and proactively planning, we'll keep audit costs down and make the audit process move more efficiently. First and foremost, I think all nonprofits should identify a champion within the organization to oversee this implementation, and all management should be involved. I would think all parties, finance and non-financial personnel, are going to want to have input, especially in some of these new disclosures around the functional expense allocation methodology. Also, someone should review the actual FASB itself. Now, I do, it is over 270 pages, but there are so many great examples, and I think a lot of it could be very helpful. And a large portion of it right now is still pending comment because it is for phase 2, which I will discuss further on the next slide. Next, you definitely need to provide training to the staff in-house or external seminars. And again, this really isn't just the accounting staff. This is also going to be very important for the development staff, especially when it's time to disclose in the audited financial statements. Also, the organization is going to need to update the Finance Accounting Policies and Procedures Manual and review the systems you have in place. And as some of the internal control environment may need to be updated. I know the Policies and Procedures Manual definitely will need to be updated given the terminology changes for the classification of assets, net assets. Something else to think about is the liquidity disclosure and what that means to your organization, both quantitatively and qualitatively. As I think this area that was previously discussed is going to be one of the harder pieces to disclose for the non-for-profit organization. So this is definitely something your organization wants to start thinking about so we can be prepared to do that note disclosures come audit time. Again, you really want to start thinking about these 5 provisions and the effect they have on the organization. Now, you may begin to include many of the changes of the ASU. However, you cannot include the following 4 without formal adoption of the ASU. And these 4 are the presentation of the 2 net asset classes. So you have to keep your temporary restricted and permanently restricted separate until you formally adopt. The second one is the underwater endowment accounting. The third is the eliminated disclosures of investment return components and the netting of the expenses. The fourth is the eliminated requirements of the indirect reconciliation if you are presenting the direct method of the cash flows.
Okay, with that, we've reached our 3rd and final polling question. What do you think will be the greatest hurdle to your organization's implementation of the new standard? Changing the net asset classifications, creating the liquidity footnote with qualitative and quantitative disclosures, or functional expense statement with additional disclosures on allocation of costs? We apologize for the issue with the last polling question, but I think we've corrected it now. Please go ahead and make your selection. And while you're answering the poll question, I'll give you your 3rd CPE word. The 3rd CPE word is cost. Again, that 3rd CPE word is cost. Okay. The poll has ended, and it looks like most of you have answered that creating the liquidity footnote will be your biggest hurdle. So with that, Walt, do you want to pick up and complete the material today?
Yep, thank you. So that phase 1 is finalized under the new ASU 2016-14, and the standard was effective August 2016. Now this leaves us with phase 2, and FASB is still deliberating over the final items that were not included under phase 1. And a lot of phase 2 is around operating measures and whether or not to require intermediate measures and whether and how to define such measures. That got a lot of discussion pushback from the community when it first came out under the proposed ASU back in 2015. They also, again, want to look at the statement of cash flow, even though they are giving us the option of choosing how we want to present that. whether it's the indirect or direct method. They want to look at some of the lines within reporting and realign them to better state the story of presenting the cash flow from operations. Also, there's a section on segment reporting for non-for-profit healthcare entities. So, the anticipated completion date, we unfortunately do not know. We will not know until FASB continues to update us through its process of redeliberations and talking about Phase 2. But I do want to encourage everyone, as Phase 2 begins to have their comment period, to have everyone provide feedback to FASB as they deliberate, because your input could impact final decisions that make about Phase 2. So that is the conclusion of our presentation. As you can see, we have left some time for questions that could come from the audience. Now I'm going to turn it back to Jennifer.
Great. Thank you, Walt. We did receive a few questions, and we have a few minutes to tackle some of these. First question, can you please clarify where board-designated endowments will be presented in the Statement of Financial Position? Trevor, would you mind answering that one?
Sure. Thank you, Jennifer. Again, before I answer the question, just wanted to briefly give a definition of what board-designated endowments are. Again, a board-designated endowment is an endowment fund created by the organization's board and is designated to use the portion of its net assets without donor restrictions, and is to be invested to provide income for a long but not necessarily specified period. As such, under the current standards, that is reflected in unrestricted. With ASU 2016-14, it will be included in net assets without donor restriction.
Okay, thank you. Another question we received, could you please clarify that the components of investment income are no longer required to be disclosed? Walt, how about that one?
That is correct. The non-for-profit will no longer have to disclose the unrealized and realized gains and losses. This can be disclosed net.
Okay, great. Another question we've received, what happens if you have a negative ending balance for liquidity in the quantitative disclosure, excuse me?
Thank you. That is a very good question. So the non-for-profit is going to have to enhance the qualitative disclosures in the footnotes. You know, this could have a rippling effect because, you know, if this is a negative amount, you know, that means that you have assets that you cannot support your net asset with donor restriction balance. So you're going to have to enhance and have a very robust footnote on what is the organization going to do if this balance is in a negative position.
Okay, thank you. Another question, can you please go over the effective dates once again? And I've also, this was another question submitted, if we adopt in 2017, do we need to present 2016 that way on our financials as well? Trevor, would you mind answering that one?
Okay. The effective date for ASU 2016-14 is for years beginning after December 15th, 2017. So if you are a calendar year, and by that I mean you're operating from January 1, 2018 through 12/31/2018, it would be applicable for that year ending 12/31/2018. But again, you should apply it on a retrospective basis. So what that means is you should apply it for your 12/31/2017 year as well. If you are a March 31st year end, It would be applicable for 2019. Again, for June 30, it would be applicable for June 30th, 2019. And if you are September year-end, it would be applicable for 9/30/2019.
Okay, thank you. Another question, when you apply the ASU, what happens to underwater endowments that are already included in the unrestricted net assets? Trevor?
Okay. When this particular scenario, if it were to happen, you will have to go back to retroactively go back and find out just the total of the accumulated losses of that underwater endowment, and it should be included within your net assets with restrictions. So from a presentation standpoint, you'll see a transfer from net assets without donor restrictions to net assets with donor restrictions. And again, those accumulated losses of that fund should be included with net assets with donor restriction.
Okay, thank you. Oh, the questions are coming in. Let me grab a couple more.
One thing I want to mention, just to piggyback on the question that with respect to the board designated endowments, with the new ASU 2016-14, you know, this is going to be presented in the audited financial statements and net assets without donor restriction, but the footnotes also are going to have to be include additional language of the board and why is this quasi-endowment or this board-designated endowment, you know, why is the board restricting it, and you know, at what point is the board going to release this restriction. So additional disclosures are going to need to be inserted in the footnotes of the nonprofit disclosing this board-designated.
Thank you. Another question that's come in, do you foresee any changes in behavior in how NPOs pursue donations, especially with regard to more in-depth conversations on donations impacted by ASU 2016-14?
Jen, could you repeat that again? I'm sorry.
Oh, sure. Do you foresee any changes in behavior in how NPOs pursue donations? I think what she's saying here is in light of more in-depth conversations on donations impacted by the new ASU.
I would say, and this is just my personal opinion, I don't think so. I think ultimately most organizations would like to have enough unrestricted, or with this new standard, net assets without donor restriction funds as possible. Again, to show to stakeholders that the organization is generating enough revenue to cover its operating expenses. So I don't think with this new standard, nonprofit organizations and those that go out and fundraise for the organization would necessarily change their behavior as a result of this particular standard. And again, that's just my opinion.
Great. This is a good one. And I don't think we've already answered this. Is there a grace period once implemented with regard to noncompliance?
I'll answer that. No, there is no grace period. The non-for-profit, you know, is going to have to implement and establish this ASU by the, if you're a calendar year, by December 31st, 2018. If you're a fiscal year, let's say you're March or June or September 30th, then you have to implement this ASU for 2019. So let's say you're a March 31st fiscal year, you are required to establish and have implemented this new ASU March 31st, 2019.
Great, thank you. Here's a more specific question. I think this will be helpful. Our restricted net assets were contributed by the board for specific projects. Do I classify them as with restriction or board designated without restrictions?
That is board designated, and again, it should be classified or included with net assets without restriction.
Great, thank you. All right. Sorry, I am looking for a last question here in the, here it is. Does ASU 2016-14 affect resource providers / decision makers such as lenders, bondholders, donors, grantors in their record keeping? Good question.
I'm sorry, Jennifer, can you repeat that one more time?
Yes. Does the ASU affect resource providers / decision makers such as lenders, bondholders, donors, grantors in their record keeping?
I would say, and Walt, feel free to jump in my opinion, I don't think it would necessarily change their record keeping, but what I will say is I know that they will pay much more attention to your footnote disclosures, specifically that liquidity and availability footnote disclosure. Because again, to fulfill the quantitative requirement, the non-for-profit organization should assess how they manage their liquid resources to ensure they can meet their cash needs for general expenditures as of and within 1 year, respectively, of the statement of financial position date. Additionally, again, under quantitative requirements, the organization should examine the external limits imposed by donors, laws, and contracts, and account for, analyze, and track any internal limits imposed by the governing board's decisions. And from a qualitative aspect, the organization is now required to take a look at its special borrowing arrangements or instances whereby the organization has not maintained appropriate amounts of cash as required by donor-imposed restrictions and limitations that result from contractual agreements with suppliers, creditors, loan covenants, and other sources. So again, I take you through the forest and through the trees to say, in my opinion, I don't think it will change how the resource providers account for their funds that they loan or provide to nonprofit organizations. But I do believe that they'll pay a lot more strict attention to those footnote disclosures.
Okay. Switching gears a little bit, I thought this was a good question. Which topics would you suggest we include in training for development teams in addition to the expanded disclosures on liquidity and the change to two classes of net assets?
I'll answer this, thank you. The first thing I would think about looking at is your current accounting policies and procedures manual, tweaking the language in there to, and it's more of terminology change. From unrestricted, temporary restricted, and if you have permanently restricted, and changing the combining the temporary and the permanently restricted into one classification, and if you have board designated, maybe beefing up the language with respect to the board designated. That's one thing I would do. The other thing I would do is start calculating your liquidity. To see, do you have assets to support the balance of your net assets with donor restriction? Because again, if your residual balance is in the red, if it's negative, you're going to have to beef up your qualitative disclosures. So this is something that you're going to really want to think about doing. And the third piece that I think is more important is the functional expense. All organizations are going to need to have a functional expense statement inserted in your audited financial statements, And there is additional language that you're going to have to insert in your footnotes with respect how is cost being allocated, programmatic versus supporting service. So the organization is going to have to think of a methodology, if they don't have one already, on how costs, whether it's salaries and benefits, occupancy, telephone, travel, how are you going to allocate that cost, programmatic versus supporting service? And this needs to be inserted in the audited financial statements under this new ASU.
Great, thank you. Another question, are we required to present comparative financial statements? If we will end 2017 with negative liquidity but will recover by the end of 2018, it will be detrimental to show, oops, I lost my question, I'm sorry.
To answer the question, you can show single-year financial statements. However, we'll just have to look at the beginning balance of those net asset classifications because there is a retrospective effect. And if you look at your statement of activities, you show the beginning balance. So yeah, you could show single year, but you'll just have to get us to what the beginning balance is for donor with assets, net assets without donor restriction, and net assets with donor restriction.
Thank you. I'm sorry about the question. The screen moved. I think the question was, would it be detrimental to show the 2017 comparative year with this new disclosure? And I think you maybe covered that. Okay. Here's a question. It looks like a board-designated liquidity fund, even one with a specific purpose to fund any operating deficits, is excluded from financial assets available within 1 year. Is this correct?
That is correct. Board-designated does need to be backed out. So board-designated, anything that's contractual, that's included in the classification of net assets with donors restriction would be subtracted.
Great. And I think we probably have time for one more, and this is a little more of a broader question, so I like it. With impending implementation, to what degree will organizational policies be affected? I think that's kind of a loaded question.
I mean, the one area where the policies and procedures are going to have to be updated is of course, the net asset classification. The policies governing how cost is allocated functionally, whether programmatic versus supporting service, I would recommend and would think that this would also be language that needs to be embedded in your formal accounting policies and procedures. So those are two things right off the bat that would need to be tweaked and included in your policies and procedures manual. If you have investments and that were under prior to ASU permanently restricted, now net assets with donor restriction, the investment income, you may want to update your footnotes with respect to that, where it could be now netted and it doesn't have to be separated, or it doesn't come out of net assets without donor restriction. It now comes out of net assets with donor restriction.
Mm-hmm.
Additionally, I think one thing to add with an updated manual, again, are the contributions that are restricted for the acquisition of long-lived assets. Again, as we mentioned earlier in the webinar, typically those contributions are restricted and released from restricted to unrestricted, either when placed in service or over the useful life of the asset. And again, with the implementation of ASU 2016-14, it is moved from net assets with donor restrictions to net assets without donor restrictions when the asset is acquired and placed in service, unless the donor has placed a time restriction.
Thanks, Trevor. I do have one more before we wrap up. I had misplaced this question. We received so many. Will there be any changes to the Form 990 as well?
That's a great question. And unfortunately, you have two audit partners on this call, so that's a great question. I don't believe so. I know I had read somewhere there had been some talk how this would affect the 990 presentation. Yeah, to be honest with you, I don't want to give you misinformation on that.
However, what we can do is talk to our 990 specialists, and whoever gave us that question, we could respond and get the answer for them.
Sure, that sounds great. Okay, with that, I'd like to thank everybody for joining us today. Don't forget, at the end of the webinar, there will be a survey where you can input the CPE words. We also want to invite you to join us next month for the continuation of our webinar series. We'll do a year-end tax update on November 14th, and you'll be able to register through our website to join us for that one. Again, thank you for attending today, and have a great day.